On the screen here, remember that last video, we just talked about how the top chart was futures prices on the left and yields of bonds on the right. The lower screen here, we have the exchange traded fund, just the regular 20-year US Treasury bond fund. But as well, and that's the blue line, as well here we have on this chart a yellow line, and this represents the TIPS, or the inflation protected treasury notes. These TIPS carry a premium to them. It's attached to an index that the government follows, and the market follows too. And the index basically tracks inflation. If the index is really high, then investors in these TIPS get an extra payment based on that index. If the index is really low, then you get no payment. Hopefully you can appreciate that if inflation is running really high and there is a fear of the purchasing power of these bonds going forward, people will pay up for that inflation protection. It's there, and if it's a worry in the marketplace, then what you will find is that the TIPS bonds will trade at a premium to the regular non-inflation protected bonds. Hopefully you can appreciate these are both on the same scale. It's pretty obvious that the TIPS bonds are not carrying a premium right now, right? This is in, let's see if we can see this over time. There was a time not too long ago where the TIPS did trade at a premium to the regular bonds. So please understand, and that's not even that long ago, that's 2014, right? You can literally see how there are some times when investors will pay that premium for the TIPS, right? Because they're worried about inflation. And there are other times, like right now, where investors simply will not pay that premium. And this can be extremely valuable information for us as investors, because what this is a real life, real reality, market-based proxy on investors' perception of inflation. You know, I know a lot of the audience really doesn't like listening to the bureaucrats, the talking heads, listening to CNBC and their sort of quote unquote experts who are just, you know, market participants just like you and I. And they always have opinions. Well, I think the market is going to do this. I think the market's going to do that. And quite often it's an interpretation of the data that's most recently been released. What I like about listening to a proxy like this is people voting with their pocketbooks. And I absolutely guarantee you, you know, keep in mind Goldman Sachs's, right? Merrill Lynch's, all the big boys, they are voting with their pocketbooks too. And these are big honking ETFs, right? You know, maybe even trillion-dollar market caps now. Billion is well, that's a 1990s word. There is a lot of money and a lot of big bets placed in this market. So what this market, what the actual relationship in this chart, unlike this where we just, you know, overlaid one and the other on the same chart, this is very simply that spread. It is one, right, the TIPS minus the TLTs, right? And so this chart gives us a just simple plus or minus reading. And the interesting thing is, there is the zero line way up there, right? It almost looks like it's a distant memory. Oh, look at that. I was even generous. I gave a 0.14. Let's go 0, right? It should say 0. I'm not quite sure why it's not doing that. But anyway, that's here nor there. The bottom line is you can see roughly where the 0 line is. If we zoom out over this, really what we should see here is over time a really good sort of picture of the perception of inflation in the marketplace. Maybe we'll even go out, let's see if we can go on a weekly chart. So, for those that have taken my course and understand the demographic significance of what's going on in the world right now, this really shouldn't surprise us. And, for those people that understand some very basics about technical analysis, market structure, those kind of things, you can clearly see sort of very, very well defined, actually, I don't want to use that, well-defined bearish market structure, i.e. a bearish vote on inflation there, and there, and there, and most recently there. You can see the turns, right? But the turns, other than this one, the turns sure look like V bottoms, eh? A lot of this sort of down and up. The only one that didn't was this one. We get more sort of like V bottomy type action in here. Really, what do we hear going on in the world? Central banks printing money and throwing bags of money at the marketplace. Hopefully you can appreciate that that's not the kind of behavior that central banks really want to do. They would much rather the economy just do its own thing and they just sort of stand on the sidelines and watch. But the fact that we're seeing such stimulus, and then we look at a chart like this, it's just market-based proxy of inflation. You guys tell me, does the market believe we're in inflation or deflation? Clearly, this is very deflationary. Where I find it interesting that we're coming into the ultimate cycle peak, which should be Q3 2017, right? Somewhere in that area. I don't know whether we're going to take out these lows or not, but you can see the steamship in the open ocean. It sure looks to me like we got another big wipeout here. And considering that this cycle doesn't come until at least another good year, year and a half away, and I caution people, don't get too excited to look for the bottom on that exact day. This, remembering our business cycle, right? Usually recessions happen in years that end. Where the hell's that damn chart go? It's around here somewhere. Oh, darn. Sorry, guys. Where'd it go? Oh, here it is. Yeah, there we go. Usually recessions occur in years that end in 8, 9, 0, 1. This is going to be really sloppy through here. Sadly, of course, this is the cycle apex. You remember, the last fear cycle apex. The Dow took like 2 or 3 years coming out of 1980 to actually turn and head back up. So inflation right now should not be a major concern of ours. What should be a concern is really how badly, how deeply do these central bankers have to devalue their currencies to sort of stop this trend. And the irony of it all is it really has more to do with demographics and money flows, in my opinion, than any central banker policy. They're just sort of trying to hopefully you guys can understand that if they print a whole bunch of money and they inject it into the economy, what hopefully will happen is that inflationary force will offset this deflationary force. And so things like the stock market just basically go sideways. Where's the stock market? Right? You could actually argue that stock investors, while it's been one hell of a roller coaster, really the stock market hasn't done anything for, you could argue we entered this trading range back in mid 2014. And really, to all intents and purposes, the stock market really, it's up and down like a horse drawers, but it really hasn't done anything. And my hunch is we got a whole bunch more of this ahead of us. It's going to be up and down like a horse drawers. But I don't think we're ready to break. Why? Well, our last video, we talked a little bit about the yield curve and the fact that the yield curve just isn't ready for a recession. If anything, we're sort of like right about here. We're not quite here, but we're sort of, the economy is trying to grow. And the sad part about it, of course, is we have these, and that was the purpose of this conversation, is we have these overriding deflationary pressures, right? Think demographics, think baby boomers leaving the economy, buying bonds, right? And really ultimately, let's look at our bonds. I see a lot of WE type action. I see yields continuing to make new lows. So until this stops its bull, right? And there was a big structural breakout there. Here's the TLT, right? You can see on a longer term, it goes sideways and then breaks to new highs, sideways. My hunch is we're going to get another break to new highs here. As this sort of deflationary spiral plays itself out, think, open ocean liner in the open seas. Central bankers are doing nothing more than just printing, just to keep everything stable. I mean, that's the sad part about it. What the market, I think, will ultimately realize, and I think you guys, the reason why, well, not you guys, a lot of participants that I'm here with, of course, we're Bitcoin bulls, right? And we're invested in Bitcoin and in the Bitcoin story. And the reason why we're invested in the Bitcoin story is because this won't be diluted like they're doing to the US dollar, the euro, the Japanese yen, whatever. And so as a result, things like Bitcoins, things like gold, things like oil. Oil is a whole conversation unto itself. But things like gold, right? My hunch is these things are going to move higher as these central banks just keep diluting these assets. So we sort of got off topic, but it's important for you to understand the sort of broader context and what's really going on in the market. And more importantly, the purpose of this video is to try and put what's going on in this very real market-based proxy, investors investing with their hard-earned dollars, into perspective. As soon as we start seeing some bullish market structure, and ideally, the irony of it all is if these lows can hold and we can turn back up through this, we'll put in bullish market structure, which we haven't seen for a long time. And then, of course, on a longer term basis, if we can get back up above this level, then we'll know that structurally inflation is back and the economy is back on track. As it is for now, we still have to be very concerned with how we actually seen the bottom in the deflationary spiral. And this is an excellent tool for you to actually see in the markets, in the marketplace, what investors are thinking and feeling with their pocketbooks. Okay, so why don't we leave the video at that? You guys have yourself a great day. If you do have any questions about this, by all means, feel free to ask. I'll be more than happy to try and help you. Oh, and by the way, this is an excellent example of intermarket analysis relationships. Actually, both of these. That's an intermarket analysis relationship, and so is that. All right, you guys have yourselves a great day. All the best, and bye for now.